Hey Jay. So now shall we continue looking at the strategy we looked at earlier for Tesla? We stopped where we saw that it's a high risk, high reward kind of strategy. So for a similar strategy, but how can we modify this with reduced risk and reduced buying power?
Sure, Ramya. Like we touch based on this briefly in the last video, right? I mean, we entered a short strangle, and then we said if you need to make it a defined risk one strategy, then you introduce a protective leg on both sides, and that strategy is called a short iron condor. So now, having said that, we will probably go back to our Tesla example here. So this is what we entered, right? So let me just remove all this simulation that we did. So this is the one that we entered as a short strangle, which is expiring on June 2026. This requires a margin buying power of close to 10,000 or 11,000, depending on which platform you use. And as you can see, this is not shown here. But let's say if Tesla skyrockets to 600 by something happens and then SpaceX goes public and then it can actually the loss can be ideally, I mean, on the sell call side the loss can be infinite. On the sell put side the loss can be equivalent to the stocks can get assigned to you, right? So this is still an undefined risk strategy, and the margin buying power, while it starts with something, it can also shoot up significantly if you just ride it just like that, right? So how do you protect yourself from such a sharp spike also? You add a protective leg. What do I mean by protective leg? There is a sell put, and then there is a sell call. When you add a buy put for the same expiry, June 2026, with the width can be just give me a width, probably 20.
20, yeah, $20.
Okay. So 325, and then I will do 305 buy put. And then since you did a sell call, you're doing a buy call on the other side. Basically, you're adding a protective leg on the call side as well. So if you do this, you're going to do a higher than this. Basically, what it technically implies is you're doing a put credit spread and a call credit spread.
Credit spread.
Both sides are credits. The put credit spread is bullish, call credit spread is bearish, making it neutral, right? So if you add this, as you can see, this is how it looks. Basically, if Tesla remains between, so what happens is technically when you add this, you previously we saw that we received $995 premium, right?
Right.
But here you are receiving close to $400, depending on the bid ask and all, $389. If
Right.
Tesla remains between 321 to 453 until June 18, you get to keep this premium.
Mm-hmm.
And what is the buying power that is utilized? Although you have added on both sides, the 20 is the width, right? So the max buying power that is utilized is $2,000. For $2,000, it won't add buying power on both sides because it is countering each other, right?
Correct.
For $2,000, $389 is like almost greater than 20% of gains, right?
Yeah,
You're
about 20% gains. And we have to remember that we're only talking about June, which is like 2 months from now.
Yes, yeah, and yeah, it's around 20% of the of gains that you will probably end up keeping. And the other beautiful thing about this one is, let's say if Tesla goes to 500 by May, the previously what we saw, it was like the unlimited this thing, right? This
Loss.
one, your max loss is limited to
Limited.
1,611
Right.
on both sides.
On
If
both.
it goes below or if it goes up, you are kind of defining the risk to this level. So even if it is 500, even if it goes to, let's say, 290, you're again limiting the risk to this one.
Right. So I think the strategy seems more appealing personally to me because one, the rate of return for the margins used is higher. The risk is limited on both ends. I don't have assignment risk on the short side, and as well as I on the upper side, my sell call is protected by the buy call. So definitely, I'm of the attitude like more trades with lesser risk than one trade with big risk, right? So um, definitely, I think between the two, I prefer a strategy like this.
This is a much more safe strategy, and for, like you rightly said, for minimal usage of the margin buying power, you're getting close to 20% returns. I mean, even here, there is a possibility that it can get assigned if it drastically falls. But since you are protected by the buy put, you can always use the buy put to sell the assignment. Or, I mean,
Right.
you always have the right to, you know, leverage this particular leg to compensate for that. So this strategy is the most sought after when stocks kind of trend sideways for a longer period of time.
All right. Great,
Okay,
Jay.
thank
Um,
you. Yeah,
Maybe we should have a follow-up, Jay, which explores. Right now, you used Fidelity to show the trades. Maybe as a follow-up, we will do the same thing using another platform called Tasty Trade, which will just give viewers a different insight into how it works in different platforms.
absolutely, Ramya. And probably we will also we effectively use options play. I mean, from our investment club, we are paid members of subscribers of options play. We will also simulate and then see, because it's quite easy to look at simulation and then pick the trades before we enter into our chosen platform. Thank you.
Thank you, Jay.